Well, it's that time of year again, earnings season, where every company in the public markets is required to report their quarterly results. We get to check in and see how they're doing, how things are running, and how the profits look for the company. Now, this week we have a couple important companies reporting earnings. We have notable ones like Tesla, Netflix, TSM, we have ASML, we have a lot of financial companies, and so on and so forth. But we really get into the bigger companies, the more notable ones, next week. Next week, we have Microsoft, VICI, Union Pacific, S&P Global, Texas Roadhouse, Mastercard, Canadian Pacific, and we have Apple early next month. So this is going to be a very busy couple of weeks. Now, while we look forward to these earnings reports, we also have a market that's bullish. Stock prices are going up. The S&P 500 continues to go up further and further every single day. Investor sentiment is greedy. In fact, it's extremely greedy. Investors right now are very happy. And this is different than what the analysts currently believe. There's reports like this from the Wall Street Journal. Companies and the terrible, horrible, no good, very bad earnings season. Well, that looks a little bit different. The terrible, horrible earnings season. Companies are now starting to report their second quarterly results, and from the looks of it, this earnings season will be remarkably bad. Analyst estimates now point to earnings per share at companies in the S&P 500 falling by 8%. And don't forget that earnings per share is typically flattered by the retiring share count through buybacks and the like. Analyst estimates are that the S&P 500 net income will fall 11% year over year in this earnings season. So while investors are looking forward to earnings season and bidding companies up, we have the analysts saying that it's going to be horrible. So will this earnings season be good or bad? We don't know. We don't have control over that. But what we do have control over is how we prepare for it and what we do during earnings reactions. And that's what I'm going to be going over in this video. My game plan for this earnings season. You might notice that I have a little bit more cash than usual in my cash account here on my brokerage. I currently have $11,000. This is from newly allocated capital as well as accumulated dividends from big payers like VICI. I've let it sit here for a while. For over a month now, I've been accumulating cash. And by the time we get into next week with the new earnings, I'll have $13,000 in cash ready to go. And my plan with this cash, simply put, is to look for deals on good companies. I put together an intrinsic value estimate of every holding of mine, as well as my watch list. So I added some new companies that I'm going to be looking at as well. And then I'll be using this earnings season as an opportunity to buy these companies if they go into my buy range, if they go into the undervalued range. So in this video, we're going to be reviewing the intrinsic value estimates of each of these companies, my thesis on them, and why I picked these companies as core positions, and we'll be going over the same for my watch list. Why did I select these companies, why I think they're worth watching, and what price range would I buy them? So this is going to be a little bit longer of an episode, jam-packed with analysis and research on each of these companies and the ones on my watch list. So I hope you enjoy this type of content. Without further ado, let's go ahead and jump right in. Now, the first thing I'll mention is this strategy of investing in high quality companies that I call compounding machines has been working. In fact, it's been working really well. The portfolio performance this year has been great. Month by month, it's usually beat out the S&P 500. Year to date, we're up 20.63% against the S&P 500's total return of 18.87%. So we're beating out the S&P 500 by a couple percentage points this year, and we did the same last year by going down less than the S&P 500. 2 years of consecutive outperformance by a couple percentages may not seem like a big deal, but that really starts to accumulate to a bigger amount of capital. But not only that, the portfolio performance has also been steady. There hasn't been any tragic events of companies going down 70, 80, 90% in value. I've never had any bankruptcies in my portfolio. We've avoided these catastrophes entirely by selecting high quality companies. Companies with incredible balance sheets and great business models. Companies that have pricing power and favorable economics. And companies that have very long, predictable runways of growth. So I've enjoyed doing this strategy, and I still feel out of Terry Smith's 3 steps of buying good companies, not overpaying, and doing nothing, I still believe the first step is the most important. buying good companies. My selection criteria for that has been the biggest focus of my portfolio. But today we're not going to be talking as much about buying good companies as we are the price that we pay. We don't want to overpay for good companies. And earnings season is a unique time where we can sometimes buy companies at cheaper prices. Now let's go ahead and start off by looking at the intrinsic value estimates, and we'll be looking from top to bottom. And if you're asking how I arrived at these numbers, I don't have time to go through each company. These intrinsic value estimates are a combination of a lot of discounted cash flow analysis, looking at the operational complexity and risks of a business, studying the history and financials of the company, and of course, looking at the qualitative stuff, the stuff that's intangible, the things like the moat of the company. But ultimately, if you had to pin me down to one metric I focus on the most, it is the free cash flow per share of the company, adjusted for stock-based compensation. That metric is right here on Qualtrim. This is one that I think is key to the valuation of the companies, what the current cash flow yield is, and how quickly I believe they can grow cash flows. When I combine all of that together, I give an estimate of what I think the company is worth. Now, is this a perfect estimate? Of course not, because in some cases, I'm going to be wrong. So I try to give ranges. Ranges where I believe the company is clearly undervalued, ranges where I think the company is close to or nearby its intrinsic value, and ranges where I believe it's getting into overvalued territory. The ranges allow me to get a better framework for when to buy these companies. Now, if we start off with Apple, for example, in my last estimate of the company 9 months ago, I had the intrinsic value at $180, and that was a time period where Apple wasn't even close to $180. Now Apple trades at $194 per share, and I have likewise moved my intrinsic value estimate up $10 from $180 to $190, and the overvalued and undervalued range as well. I believe it's becoming more clear that Apple has an incredibly dominant moat and ecosystem, and over the past 9 months, I've not seen that ecosystem weaken. I see the install base growing, the ecosystem growing, and for me, the ecosystem is the key thing in Apple's thesis. If the ecosystem remains strong, this company will grow its free cash flow per share. And although the free cash flow per share right now is around 3%, that's a little bit on the lower end, the company still has this incredible growth rate where they've grown their free cash flow per share, even adjusted for stock-based comp, by 24% per year over the past 5 years. That is explosive growth in their economics. And I believe that they'll continue to have faster than expected because of the power of their ecosystem. So right now for me, Apple is basically a hold. It's trading too close to its intrinsic value estimate for me to really consider buying. And I already have a ton of Apple stock. I bought this company a long time period ago because I felt so strongly about it, and it's clearly been a good performer. I'm up $27,000 on the holding. The total position size is up $56,000. And if you looked at my first purchases of this company, they're up around 4 times right now. So this has been an incredible performer. I'm not going to be adding to it right now, but I will be holding it. Now, next up, we have another core holding of mine, which is VICI. This is the only REIT I own, and it's a experiential real estate company. They basically have a monopoly or a concentration of assets on the Vegas Strip. So they own things like Caesar's Palace, the Venetian, MGM, they own part of Mandalay Bay, and so on. They've really concentrated in Vegas. And this company had a really great 2022. It was up 11% in 2022 while the market was down 16%. So this has been one that's been a great holding, but this year it's been struggling. VICI really hasn't made any gains whatsoever this year. And part of that is a series of downgrades from banks like Deutsche Bank, downgrading 2 different gaming REITs. I've looked up the reasons why, and they don't give a real clear explanation. I find it confusing of why they would downgrade VICI. They're collecting 100% of rent. They have a starting yield that's around 6%, and they raise the dividend around 8% per year. The total return of this company should be in excess of 12% per year. So VICI for me is a company that still remains undervalued. In fact, I moved up my intrinsic value estimate while Deutsche Bank was moving theirs down. I moved mine from a $33 to $36 per share. That's what I believe VICI is currently worth today. The company, by every metric that I look at, is undervalued compared to other REITs relatively, compared to bonds, or compared to equity markets. And I believe $36 per share better represents the intrinsic value of the company. And I have been actively buying VICI over the past 6 months. Now, next up, we have Microsoft. This is one that's another big holding in my portfolio. This company has gone on a crazy run over the past year. Just a year ago, it was trading at $220 per share. Now it's at $344. So it's really had a great run. But Microsoft is a company that I still believe has increased its intrinsic value over the past year. So I moved my intrinsic value estimate from $350 up to $360. Now, why did I do this? Well, first of all, Microsoft has grown in its earnings power over the past year. The company has continually grown in strength and grown in its free cash flow per share. It's issued higher dividends, and there's more predictability in the business now that it looks likely they're going to close the Activision Blizzard deal. Owning Activision Blizzard will add on another $2 billion in free cash flow per year, and they don't have to worry about excessive amounts of debt. This isn't a leveraged buyout, so I believe the company's worth more, and I wouldn't be surprised if the company does pass 360. Now, if Microsoft sells off in this earnings report and it heads back down to 310, I will likely buy more of the company. I'll use that as an opportunity in this earnings season. But as of right now, this is another company that I have such a large holding in already that I feel fine just sitting with my holding and seeing how it goes. Now, of course, after Microsoft, we can't forget Texas Roadhouse, one of my favorite companies. This is a bit more of a unique pick. This is a company that I finally added to the portfolio after going to the restaurant and just realizing how it's continually a madhouse. It's so busy all the time. Now, Texas Roadhouse has done some improvements. They made it so you can queue with an app, and they've done different things to optimize, but the company has remained incredibly busy. Busy all the time. My intrinsic value estimates of Texas Roadhouse a year ago was $115. That's the price that I thought was the current intrinsic value. Now remember that this company, not too long ago, 1 year ago, it was trading in the range of the 70s and 80s. Now the company is trading at $116 right now. So Texas Roadhouse has met that previous intrinsic value estimate, and when I reviewed the company and I updated my analysis on it, I saw that they opened up a lot more stores. I saw that their same-store sales is growing per location. I saw that they're having a lot of efficiencies with checkout and timing to have faster turnaround. This business is still moving in a very positive direction. And when the business fundamentals are moving in a positive direction, I see the intrinsic value estimate moving that way as well. They are going to be able to generate more free cash flow this year than I think any prior year. Right now, Texas Roadhouse is one of my core positions. It's had a great outperformance over the S&P 500. The company is around a $50,000 position with $14,000 in the green. If we get a sell-off because of investors' fears over a recession, if the recession is the big talk for Texas Roadhouse, I will be buying more of the stock. I am not worried about a recession with Texas Roadhouse. Let me repeat that. I'm not worried about a recession with Texas Roadhouse. All you have to do with a company to see how they react in recessions is look in the previous recessions and see how the company's financials looked. In 2009, you can't even really see it with their earnings per share. Texas Roadhouse sailed right through it. The same thing in the dot-com bubble. They sailed right through it. I have no reason to believe that the economics of the business have changed at all. They are the same business they were back in 2009, but they are better managed now and better scalable now. The only thing that really affected Texas Roadhouse was a pandemic when their stores were literally closed down. Other than that, this company is fine during recessionary times. So if Texas Roadhouse gives guidance that's a little bit lower than investors expect, and people become spooked because of a recession and it trades down, I will add to this position. Now, another fun holding that I have is Costco. This is a very boring company. I've had it in my portfolio for a long period of time. Costco's a company that I did not buy because of valuation. I bought it because I believe the company is excellent. I think it's an excellent company that's going to consolidate big box retail, and I believe the company has an incredibly long runway of continued growth because of their success in foreign markets. This is one where optically the valuation almost always looks a bit stretched. It always looks like it's a bit overpriced. And even right now, it's a bit above my intrinsic value estimate. Costco's always teetering in that overvalued category. So I've just bought into this company. I'm not too concerned about the earnings report. To be honest, I'm probably not even going to look at the earnings report. I've been through so many of them with Costco, and they're all the same. They're either in line, slightly above, or slightly below expectations. So this is one that right now I'm just going to continue to hold. If for whatever reason we get a sell-off in the company, I'll add to this position. Now we move on to S&P Global. This is a newer holding of mine, one that I am incredibly bullish on. I'm very excited about this company because of how diverse and how powerful this company is. S&P Global shares a duopoly with Moody's Corporation. The two of those companies combined rate around 90+% of the world's total debt. All the debt in the world, 90% of it is rated by these two companies. So S&P Global has part of a duopoly, but then they're also a data provider business for indices, they're a data provider for commodities, and they control the S&P indices themselves. So they earn franchise licensing fees for S&P indices and ETFs that are based off of it. So S&P Global makes a little bit of money every time someone buys an ETF like SCHD. S&P Global makes a little bit of money every time someone buys an ETF like the S&P 500. This company also has very efficient economics. It's able to grow its free cash flow per share at a very rapid pace. But because of an acquisition they did a year ago, the free cash flow per share dropped dramatically, and I consider this a one-time off event that makes the economics look temporarily bad. I think this company is going to recover very strongly, and it has been doing that already this year with a 25% performance. So I'm very excited for their earnings report. I think it's going to be good. I don't think we're going to be disappointed with this one. I currently have my intrinsic value estimate of S&P Global at $480, well above today's mark. The overvalued territory is 520, the undervalued is 340. So that's a pretty big range, but I still believe this company is undervalued despite the great run it's had this year. That is part of the reason why I've put such a large amount of capital into this one position. It is now nearly a $70,000 position with $10,700 in the green. This is one where I love the risk reward. I love the upside and downside. I love the qualities, the moat, the diversification, the great balance sheet, the capital efficiency, almost everything about this company. And of course, if this one does sell off for some unjustified reason, I will be spending my $12,000 in cash to buy more of the company. Now, another one in the financial tech category is Mastercard. This is a company that I also added this year, and I believe the company likewise is undervalued, still to this day. I have the intrinsic value estimate at $450, the overvalued territory at $480, and the undervalued at $370. This gives me a guideline of where I would want to buy the company. I have been buying Mastercard recently, over the past couple of months. The company's been trading around a little bit this year. Overall, it's in the green around $5,000. But this is another one that I consider to be an incredibly long runway of growth compounder. There are some potential threats to Mastercard, some things I see looming in the distance that might become more relevant threats in the future. There's something called the Credit Card Competition Act of 2022 that would basically obliterate all rewards for credit cards. That is a potential threat, but the chances of that passing becoming law is minimal as of now. And while the company has an okay free cash flow yield, it's around 2.6%, there's not many companies in the market that have consistently grown free cash flows as fast as this company, around 17% per share over the past decade. That is incredible. I believe the earnings report will be fine for Mastercard, but if for some reason it's not, this is another candidate that I could be buying more of if I see a big trade down. Now up next, we have another core position, which is Intuit, another new holding to the portfolio. And this one wasn't really well received by everyone here. And Intuit's one of these companies that offers such dull products that most people associate with something negative, like paying taxes or doing accounting. So I realized that the products are not that exciting. Intuit offers boring products, but the stock and the company are exciting. Intuit is an incredible compounder, a company that's up 25% just year to date. It's up 127% in the past 5 years. It's up 670% in the past 10 years. They have a strong franchise of durable products that have stood the test of time that they continually iterate upon. And the company does have great financials as well. They're also spinning up more competitive SaaS products to grow in different markets. So this is one of these tech companies companies that I feel like gets a little bit left behind in the retail investment scene. This is left to the institutional investors, and I think that's a mistake because Intuit is a great company, and I'm happy with my current position in the company. I have around $40,000 in value, $4,600 in gains. Now, of course, we get to the railroads here, Union Pacific and Canadian Pacific. Two companies that I've added to the portfolio this year, and neither of them have had any love from the market this year. Investors are pretty concerned about that upcoming recession. They're concerned that these companies' profits are going to be hurt. Union Pacific and Canadian Pacific are both wide moat companies with incredibly long runways of growth that also generate continual, consistent free cash flow growth. So they're both ones that I think are pretty safe bets compared to most investments. I don't think they have the biggest opportunity to outperform to a dramatic extent, but I believe they're more conservative bets that will have slight outperformance of the S&P 500. Right now, I consider both of these stocks to be slightly undervalued, around 10% from their intrinsic value. So there you have it. That is the entire passive income portfolio. All of my core holdings, my valuations on them. I'll use this earnings season as an opportunity to buy more of my companies if I see an unjustified sell-off. Now, in the scenario that none of these companies have a sell-off, none of them have anything wrong with them, and all of them are doing just fine, then I may look to see if there's any value on the watch list. Here's my watch list. It's a short list of companies that I think are incredibly high quality. I believe the quality of these companies matches the quality that's already in my portfolio. So if I could buy these companies or add them to my portfolio at reasonable or undervalued prices, I think that would only strengthen my portfolio overall. Now, this is in no particular order, but the first one on the list is a company called Fair Isaac. You probably heard of them called FICO. They are a credit rating company. Simply put, all credit is the likelihood or the probability of a loan being repaid. FICO has a unique score, an algorithm to do that on an individual basis, giving everyone their FICO score, which is their credit score. And then banks and institutions use these scores to gauge the interest rate or their ability to lend to you. So that's all FICO is. The company primarily is a credit score. And in some cases, FICO is very synonymous to S&P Global. S&P Global gives a credit rating on all of the world's big debt from corporations, and FICO basically does the same thing, but on the individual basis. So you could consider FICO to be the Moody's or the S&P Global of the individual. It's the same type of company doing the same type of thing, but on an individual basis. And it has a very entrenched position with a wide moat in that industry. Now, this is a company where the metrics are also truly incredible. It does trade at a pretty high price when you look at the optics here. A 34 PE ratio, only a 1.54% free cash flow yield. But the big thing about this company is even though their revenue is growing at a moderate pace, 7% over the past 10 years, nothing fast with their revenue growth, it's their economics. The increasing economics over the past 5 or 6 years. They've grown their free cash flow at 19% for the past 5 years. And then the more impressive thing is when you actually count the shares and the amount of buybacks they've been doing, they've grown their free cash flow per share at 26%. 26% for the past 5 years. This is explosive, parabolic growth in this company. And the reason why is because of the pricing power and the capital efficiency of this business. So this is one that I'd be happy to have in the portfolio. It's one that I've been looking at for a little while now, but the price of it is always the deterrent. While the company trades around $830 per share, I have the intrinsic value estimate right now at $650. Now, what I'm hoping for is in this earnings report, any type of weaknesses that would knock the price down a bit. If I can get a good price dip on this company, I'll be buying in. Next up on the watch list, we have Marriott. This is a company I haven't talked about too much, but I really like the business model of it. I came across Marriott when I was looking at Airbnb, and I realized that their business models are more similar than they are different. A lot of people have the misconception that Marriott and companies like Hilton actually own physical real estate. But they are just as capital efficient and capital light as a company like Airbnb. They don't own physical real estate. What these companies own is intellectual rights to operate a hotel chain. They license their brand name. They license their operations in very similar fashion to Airbnb. So while this company shares a very similar business model to Airbnb, what it doesn't share is the incredibly high expectations and the fawning over the company from investors. It trades at a modest 24 PE ratio and a 3.84% free cash flow yield. So what I've done is I've looked at the fair value of the company. I want to enter the price around 150 if I can. So again, if we get a sell-off in this earnings season, this would be a potential candidate for a new company in the portfolio. Now after Marriott, we have Chipotle. This is another company that you might have noticed me talking about many times now. I've been looking at this company for a long period of time, and I have a lot of regrets of not buying this one a long time ago. It stings the most when you know a company's really good, you're on the verge of buying it, but for some reason you talk yourself out of it, and then it goes up literally over 100%. That is the case of Chipotle. I've always been on the sidelines for little concerns over valuation. Chipotle has everything going for it. This company offers food that is simple and that most people like. A Tex-Mex type of food that most people love eating. It has very simple store layouts and it has a ton of levers to pull on automation. I continue to believe that restaurants and quick service restaurants like Chipotle will benefit from robotics, artificial intelligence, and automation more than most industries. There's so many inefficiencies that can be greater automated. And this is the case with Chipotle. Things like the avocado, something that makes it so it already makes the avocados for you in the restaurant. Automating a huge process that would take manual labor. They can roll these things out across their restaurants and increase margins over time. So even though the company does look expensive right now, again, it's another one that trades high on the PE ratio and low on the free cash flow yield. This is a company that's proven to have explosive free cash flow growth and earnings way above analyst estimates. The earnings per share have literally been explosive over the past couple of years. And I believe there's a very long runway of growth with this company. So Chipotle is one that I'm looking for. Any weakness or opportunity to buy this one at a decent price. Hopefully we get that with this earnings season. If not, I'll just have to remain patient. Now, of course, we can't forget about Moody's. This is another one that I initially looked at with S&P Global. I tilted my portfolio and decided to go with S&P Global because I like the diversified product revenue. But Moody's is actually diversifying as well. They're building out an entire analytics business. They're also becoming an AI SaaS company with lots of analytics for companies to look at. I still like S&P Global slightly more than Moody's, but if we for some reason got a sell-off in this company, I would use that as an opportunity to enter the position. Right now, I actually believe that Moody's is trading around its intrinsic value. This is similar with my watch list having Visa. I chose Mastercard for some very small nuanced reasons, but I believe that both of them are great companies. Mastercard has more business outside of the credit card portion. They have a lot of things like security, identification, lots of different services they sell to companies. So they're a little bit more diversified than Visa, but Visa has the bigger market share, and both of them share incredibly good economics. I have this one on the watch list because, like the others, if it does sell off during this earnings report, it will be a candidate for a new holding in the portfolio. And then finally, last on the watch list is MSCI. MSCI is very synonymous with S&P Global. They offer very similar business models where it's an indice business. They own the indices, and it's almost like Domino's owning a franchise. MSCI lends its name out, and it lends a lot of data analytics and benchmarking tools, a lot of indice tools like S&P Global. When it does that, it charges fees. Those fees add up over time. And because the company's all digital, because it requires no reinvestment, no capex, nothing that's really expensive to run the company, it's incredibly efficient. And their cash flows show it. Look at the cash flow growth over the past 5 years. It's been 24% per year. Because of the efficiency of the business, they can do share buybacks. That makes it 27% free cash flow per share over the past 5 years, with nearly no slowdown in sight. So this is a company that trades at a rich valuation, although it's deserved, but I'd love to buy this company if I found a substantial sell-off after hours. I currently have the intrinsic value around 450. I'd like to buy this company somewhere around the 400s. 410, 420, I would be adding this position to the portfolio. So there you have my intrinsic value estimates on all these different companies. And what I plan on doing, and I think the best attitude to have with earnings season, is if things do go south and lots of companies sell off, look at that as an opportunity, not as a problem. I'm storing cash right now specifically for that opportunity if it arises. And if not, I'll go back to doing what I was doing previous. So that's my strategy this earnings season. Let me know what you think, and I'll see you in the next one.